In local business, Singapore's third quarter growth hit 4.1%, beating market expectations. Advanced estimates show it surpassed the second quarter's 2.9% growth. It was boosted by the manufacturing sector's rebound. Now, the sector grew by 7.5%, reversing the 1.1% contraction in the previous quarter. However, the construction sector's growth lost momentum. It grew 3.1%, easing from Q2's 4.8%. Other sectors, including the wholesale and retail trade, also grew at a slower pace. Now, these expanded by 3.5%, lower than the previous quarter's 3.9%. And some analysts still expect continued growth, but cautioned about external uncertainties could affect the momentum.
Economic growth could still be around the 2.5 to 2.6% range between this and next year. I think growth will continue to be quite broadly supported by manufacturing and services.
Singapore's central bank has maintained its monetary policy for the sixth consecutive time. This means the appreciation of the Singapore dollar is unchanged. The Monetary Authority of Singapore also expects core inflation to decline further to around 2% by the end of this year. Core inflation, which excludes accommodation and private transport, was at 4.2% last year. MAS also anticipates headline inflation to be around 2.5% this year, compared to last year's 4.8%. Growth is expected to remain steady, reaching the upper end of the 2 to 3% range. An analyst says with inflation under control, it's unlikely the monetary policy will change. However, he cautions there are still inflation risks from global tensions, and these could potentially affect supply chains and drive prices up.
If we are going to see downside risk for growth, at least for Singapore, then that must also be accompanied by a slower than expected price pressures into the next year. So that basically means that I think the balance of risk is for the MAS to actually cut monetary policy into 2025.